right, everybody, welcome back. Welcome back again. We're going to continue our discussion about the calls and the puts. And in this one, it's strictly buying calls and strictly buying puts. I think I've made myself pretty clear on the fact that it's not that I'm against buying calls or just buying puts. It's the fact that you got to protect yourself against that implied volatility. So if we're going to do it, we need a way to do it, right? So what we want to look at is comparing the different ways that we can do this. You really want to know how to use the Analyze tab. I can't stress that enough. You don't have to be a quant trader and a math geek to trade options. Let the broker platform do the work for you. But if you can do the math, do it. If you can't, then you really need the analyzer. Hands down, full stop. So let's trade a call on this, right? We're going to look at this and we're saying, okay, we're at the bottom of structure. We could make the argument, that we're messing around with this zone here, and we're going to expect SPY to stay above this area, right? We're looking for it to go up, so we're going to trade a call. But we're worried that when it starts to make that move up, we're going to get vol crushed. Now we can go in and we can look at these options for Friday, and we want to pick a couple of different choices. Now it's easier to see the effects if you pick something in the extremes, right? So in this example, let's pick something really deep into money. We're going to buy that 294 and throw it over to the Analyze tab. Okay, so now I've got the 294. Let's just stop here and take a look at what I did. On the screen, you can see three gold lines. One of those lines is the current price. That's $300.10. That is the price of SPY right now. Okay, that's this gold line right here. That's current market price. Notice if the market just completely fell, right? If it just crashed and burned, it would have to be all the way down here at 294 where I bought that call for me to make max loss. What if it just stalls and doesn't go anywhere? It just stays right at that 300 all week long and into the close on Friday. How much would I lose? I can just stop my mouse right there, and we can see that this call, which is $948, would only be a max loss to me of $341. Now, I don't want to lose $341, but I would much rather lose $341 than $948. But that's my max loss if the market just stays right here. All right, this cyan line is our max loss in this trade. Okay, so down here, the max loss bottoms out. It caps at 948 because that's what I paid for the call. I can't lose more than what I paid for it, so that's all that I can lose. If it stops anywhere along the way, then that's going to be what my max loss is, and I can just stop my mouse and look at it and say, look, that's my loss. That's all I can lose. So let's move through time a little bit. And this is a weekend, the market's not open, nothing's moving. But what happens if we take it through time? This is a July 2nd trade, so let's bump time forward. Now remember, if you're going to walk through time asking what happens in the future if, then this is the calendar you want to mess with, not the one up here. The one up here, this is what it uses for calculating your expected move. Okay, that's the gray area that you see on the screen. We're not really interested in identifying where the expected move is, so we don't really need to worry about this calendar up here. But what we do want to know is, will this change and adjust as time goes by? We want to go into the future. We'll use this calendar. So I'm just going to start bumping through the days. Now, one thing that you should notice right away is that cyan line, it never moved. That thing is locked in stone. Okay, so all the way up into expiration, that cyan line never changed at all. So here we are one day before expiration, and you can see that that purple line, the plum colored line, that one was changing and it was sinking down to match that cyan colored line. We're going to make that cyan colored line red to indicate that it's a loss, or that it's a negative. Okay, so that green line is what we could make, and the red line is what the value of that option would be at expiration. And at any time, you can just stop your mouse and look to the middle left portion of the screen which is right here. And where you stop your mouse, you can see the value of the option on this date in green, and you can see the value of the option in red. So I accidentally moved one of those gold lines. That gold line that I used moved was the current price. So I need to reset my slices. I'm going to use $2 and $5. Now I don't need the negative side. We're not looking negative. So I'm just going to delete the negative slices out. And what we have left is the current price, which is showing the zero here. It's $300.10. And then we've got a $2 move. And then we have a $5 move. So from its current location, if SPY was to run to 302.10 between now and the 2nd, this trade would still be in the hole $78. Okay? So that if the market closed at the end of that day, I would still not have made my $948 back, but I would have made money, right? I would have tried to pay this off, but I'm not yet to break even. Break even is still over my head. I'm not there yet. I need more to get there, right? So from that, we can look at this and say, okay, what about one day sooner? If the market had made a run from 310 cents to 302.10, and I just stopped my mouse there, look at the green. It's still minus $30. So I made most of my money back, yet I'm still below that break even, right? The sooner we can make a move, the faster we can get paid. Now look, if I stop at that $302.10, I'm actually positive $11. This is 6/29/2020. If we look at this 6/29/2020, that's Monday. So at Monday evening at the close, if SPY runs up to 302.10, this call could be worth $13.02. So I would have made back the $948 that I spent, and I would be positive that $11, and that's it. So you can see that if we just buy a call and the market makes a $2 move, we're really not going to get very much, and it needs to make that move by Monday afternoon. All right. As soon as the next day begins, now that $2 move wouldn't even get us to break even. We wouldn't even be profitable at this point. We would need a market to make more of a move, okay, at expiration. So by Friday into the close, we need SPY to be above 303.50, or we're going to lose. We don't know how much we're going to lose, but if it's not at least there, we're taking loss. Okay, so the break even for us is that red line right there. That's the break even. So we need it to be there. We can just move this up, right, to a day before. So that's what we got to worry about. And then we have to ask the question, so what if I get vol crushed? So we can go in here and we can subtract 10 points of volatility. And I know it's extreme, right? We wouldn't really see a 10-point vol crush, but it helps us visualize what would happen if. So what happens to my call if we get vol crushed? And we're looking for SPY to make a move up. It would make sense that we would see volatility go down. If I hit enter, we want to see what happens to this green line. Oh, it sinks, and it sinks fast. So what that demonstrates to us is that as price moves up, that volatility is sucking the value out of our option, and we're going to need to see a move beyond our break even to see that profit. But I do want you to focus on above the break even, because our profit is there even in a vol crush. I could put 100 points out of that thing. Our break even still has value. Okay, so here's the break even at that 303.50. If SPY was to run to 305.10, I'm still going to get my profit of 164. It wouldn't matter if we have minus 100 implied volatility or not. My profit above break even is still there. Nothing changed that. Okay, so when we talk about getting vol crushed and we say, well, you know, I can't make money in the call if I get vol crushed. No, guys, that's not what I'm telling you. we want to close these trades down before expiration, right? We want to see a move and then shut it down and move on to the next trade. We don't want to have to sit in these things waiting for expiration. And so if you get in a trade on Monday and you're looking to close it out by Tuesday or Wednesday, you better see a big move and you better not fight vol, or you're going to be sunk down here. Okay, but if you're above that break even and you get vol crushed, it won't stop you from making the profit that that trade should have always made. And that's because the intrinsic value that's in that option can't be taken out. The implied volatility crush is only going to deal with the extrinsic value. And that's a fickle beast. Okay, it can come and go, it can hurt you or help you. But the intrinsic value, the red line above break even, that is a solid beast. It's an island that cannot be shaken loose. So that implied volatility will not ever take that intrinsic value away from you. And if we run to 305.10, no matter how much vol crush we get, we will get that profit. But you're going to have to worry about getting assigned if you try to hold a call that's in the money at expiration. So you got to bail out of that thing. You'll never ever make the max profit. So if I'm looking at this and it's 305.10 and we're 2 minutes to market close, this thing might be worth $160.30. Give away the $2.07, right? Just close that sucker down. Don't hold it into expiration, and that's as close to max profit as you could get. So hopefully, guys, this demonstrates to you that you can trade just calls and just puts, and you can get past the implied volatility. As long as you're above that break even, you're fine. Now, I built this one deep in the money. It's a 294. What if we was to do it the other way? So let's turn this one off. And let's go out here and grab a 30. We're at $300.05. So let's grab a 301. $475 for an at the money. We're not at the money, right? We're above. So the 301 here, the break even is still above that 300. Okay. Now that 294, let's just go back and revisit that a moment. There's the 294. Okay. The 294 has the pivot point way down here. We turn that off. We got the pivot point now is above our break even. So to be profitable in this trade, or not profitable, to avoid this max loss, we need SPY to begin running immediately. We got to get above all of this mess as fast as possible. Look how far away that break even is. 305.78, 75. We've got to get price way above that. And if we get vol crushed along the way, this green line, guys, it's going to get you. I want to start moving this, and I want you to see how, as I'm decreasing the volatility in this trade, right, I'm vol crushing this thing, and it's like slow motion. That line is just sinking lower and lower. Our profits are falling faster and faster, right? That's volatility crush. So taking the trade at the money, while it was a cheaper option, it left us really exposed to all this volatility crush, and we need to see a massive move in this thing, or we're just sitting in a loser. That sucks. All right, you could get everything right, expect it to hold the line, expect it to make a pretty decent move, and it could go from 300 to 304. You'd still be in a loser. It could go from 300 to 305. You'd still be in a loser. Only if it made an immediate, sudden, strong rally and volatility happened to accidentally go up would you see money in this trade. Okay, so this at the money call, or just slightly out of the money call, that's a losing idea. All right, so we looked at the 294. Could we go any deeper? Would that help? What if we went all the way out here and bought these 288s? Now look at the pivotal break-even point, or the pivotal max loss point, is way down here at the 288. So while this did cost $1,442, to take that max loss, we would need to see SPY fall all the way down to 288, which means we can give this thing room to run. We can ask the question, what happens if it falls to 299? How much could I lose at that point? Well, our max loss at 299 would be $335. We'll round up and say 336. So that could be my line in the sand. I could say, look, I've got unlimited upside. I'm looking to make $400, and I'm willing to risk $340 to do it. So if price drops below $299, I'm bailing out of my trade. Okay, that's a little better than a 1-to-1 risk to reward ratio. So at that level, $300.10, this is the current price in SPY. We would need SPY to rally above 302. That's our break-even point. Anything above that at expiration is profit to us. It can't be taken away by vol crush. Okay? The 305.10 at expiration would pay us $265. Right? 305.10 right there, $266. So we can see the target profit zone. And we can ask the question, if I'm getting ready to buy this call at $300, right? SPY's at 300, I'm looking to buy a call, and I go out to the chart and I look and say, okay, the top of this range is 320, and well, we'll call it 315. Top of the range is 315, and the breakout potential was 320, 322.5. Okay, so 315, 322.5. Let's go move our slices back. We'll move the first one to 315, and we'll move the other one to 322. And we can see the P&L right here. What would the trade be worth on June 30th? What would it be worth on July 1? And then at expiration, what would it be worth at expiration if price did make it up to that 315? Now remember, we're talking about a $15 run in the next 4 days in SPY. Can it do it? Are we asking too much? Well, let's look at the expected move. It can go $10 higher, or it could go $10 lower. That's a combined move of $20. Could it break out of the top of the weekly expected move? Yes, sir, I do think it can. We've seen it before, right? So are we asking too much? I don't think so. I think it could make that move. If it did, if it made it to 315 at expiration, this call would be profitable at $1,258. If it broke out from there, it could have a max value of $2,000. But what about that other one, the cheaper one here, right? The 294 option instead of the 288. So let's swap it over. Now my max profit is 1152 or 1900. Okay, so let's look at that 315. We're going to get rid of the 22.5. The only one that we want to focus on is that 315. The 315 would put us right at the top of this range, right? It's still a breakout of the expected move, but it's at the top of that range. That's what we're going to look at. And we're going to ask the question, if SPY came back up to the top of this range before Friday or by Friday, which one of these calls would make me a better trade, would pay me more money? The 294 strike would make 1152. The other one would make 1252. We'll just use the twos to make it easy, right? So an extra $100 Is it worth getting a $1,442 call to make an extra $100? Or would you be better off just taking the cheaper one, maybe two of these instead of one of these, right? So we could get this single here, the 294, and make 1158. Or we could get the 288 deep, deep, deep in the money, and we'd only make an extra $100. It isn't worth it. So what else could I get, right? The 294 is deep. The 288 is really deep. What about everything else? What about anything in the middle? The 298. Let's take a look at that. And it's going to be the same distance move, right? Instead of spending $948, what if I only spent $662? I could literally buy two of these and it'd still be less than buying one of these. So here's the 298. If we made that same move back up to the top of that range at 315, this one would make $1,000. So $100 less, but I'm risking $300 less to do it. Okay. Does that work? Sure it does. Let's go ahead and take that 301 again. So here we are, round the clock. We're right back where we started. We're looking at just outside of the money, the 301. And SPY makes a $15 rally next week. And we're asking, what could I make in this trade? $926. It only cost me $475 to do it. I could get two of these almost for the price of this one for that 294. Remember, if we have two of them, we can scale, right? We could close one out, add, say, $400 profit, and let the other one run until $800 profit. We could really start making some money out of that, right? We can lock in profits along the way. So if I get a cheaper one, I can get more of them. None of it would matter, though, unless SPY got above that 3055. If we couldn't get above that, then we're just going to be taking loss anyways. Now, hopefully this demonstrates to you guys that you can analyze something just as simple as a call. Just buying a call and asking the question, what happens if? What happens if SPY actually gets to the top of that range? How much of a move do I really think I can get? And is it worth buying that one deep, deep in the money? Or should I go ahead and come up to the money? Or maybe a little outside of the money? Our expectations let us know which strikes to pick. You could screw around with the Greeks trying to figure out all of this with a calculator, or you could let the broker do the work for you. So you identify the trade, and then you go find an option build that fits what your trade is trying to accomplish. Hopefully you understand that you can trade calls, you can trade puts, just buying calls and buying puts. And as long as you get above that break even, it doesn't matter how much volatility spike you get or crush you get. The red line, or for you it might still be the cyan line if you didn't reset it. That at expiration line will not change no matter what happens to the volatility or the gamma or anything else. It's locked in stone. So as long as you're above it and you're willing to hold damn close into expiration, we're talking about playing chicken on Friday afternoon with the clock. If you're willing to do that, you can see a profit near that red line's value. And you just stop your mouse and look to the lower left and you can see what that value is. It's not a guess. It's not a maybe. That's a fact. That is the value. You just got to see price get there. I appreciate your time. I look forward to seeing you at the next video.